The financial section of any business plan is by far the most complex section of all the business plans. In fact, the financial section is so complex, I'm not going to be able to really dive into the financial section in great length in this video. So if you need help with the financial section, please reach out to one of our certified business advisors for help. The financial section typically includes a source and use, otherwise known as a startup cost, income statement, also known as a profit and loss, cash flow statement, balance sheet, and typically some kind of break-even analysis or ratios. The source and use statement, which we'll start with, is basically the amount of money you're going to need to either start up the business or to continue the business, for equipment or operations for expansion. And it's broken up into two sections. One, what are you going to use the money for? So what are the uses? And two, where is the money coming from? And remember, each one of your financial statements should have some kind of notes denoting where exactly this information is coming from. And these notes can refer to either the appendix or to another section of the business plan, but you're trying to help the reader understand where you're getting these numbers. And remember, the use section must equal the source section, right? So the amount of money you're asking for must equal the amount of money that you're going to be getting. Now, oftentimes when I'm talking to a business, the owner cash is an important part of talking about the business, because most lenders or investors are going to want to see that you have put some kind of money or some kind of skin in the game, is what they call it, right? So you have something to lose. If you were to go to a lender and say, hey, I need 100% financing, more than likely you're not going to get it, because what you're really asking them, or what they hear, is, hey, I need you to take all the risk and me to take none of the risk. Right? So when we're looking at the sources, one of those sources should be yourself. Depending on how risky your business might be, that can be anywhere from 10% up to 30% or more. 10% being less risky, and the higher percentages being more risk. So for instance, if I were starting a dentist office, it might be a 10% down. Whereas if I were starting a restaurant in the Portland area, it might be more like 30% down. Now, the bank is also going to be asking you for your credit. So understand what your credit score is before you go to the bank, because they're going to look at your credit. They're going to look at how much money you put down, which we often call your capital. They're also going to be looking at this use section as what collateral is in the deal, right? So the collateral, again, is something the bank can take if the deal were to go south. If you were to stop paying on your loan, this is what the money went for, so the bank could take it back and then try to resell it. And oftentimes when we look at a deal, we want to make sure the bank has enough collateral in the deal that they're comfortable making that loan. If there isn't enough collateral in the deal, then we got to think about another source of collateral, right? Is this collateral you're going to bring in from outside? So you maybe have equity in another property or an investment account, or perhaps you could get a guarantor on the loan, someone who would essentially co-sign the loan for you. Another option, but this is the bank's option, is whether they put some kind of government guarantee on the loan, an SBA, FAME, or USDA guarantee. But that is a call that the bank makes. So what you're trying to do is you're trying to put forward what you need to start the business, just to open the doors, because that will then tie into the next section, which is, okay, once I open the doors, how much money is it going to take just to keep the doors open? And in this section, what we do is we try to put our best foot forward. So we start with revenue, and just like the products and service section, you're going to start with your money maker first, and then go through the auxiliary services that you might offer or products. So you start with your revenue up top, and then you have your expenses down bottom, and then you're hoping that the pre-net profit, that pre-tax profit that you're going to make, is going to be positive, right? Now, a lot of businesses get worried because the first few months, like you can see in this example, the first few months are negative. Negative is when you see those parentheses on either side. Well, when you're first starting a business, there's a good chance you're going to be negative for a little bit and then go positive after a while. That's okay. That means that you just need to make sure you ask for some working capital. Working capital is any cash excess, so any cash that you need in the bank to make sure that you're able to pay your expenses as you go. So in this case, we know, hey, maybe we need to ask for some working capital with the loan. And again, look at the bottom where you see the assumptions. It's always important that when you get someone looking at your financials, that they understand where these numbers are coming from. And that's what these notes, these assumptions are doing. They're explaining the numbers up top. They're saying, hey, this is how I'm getting sales or whatnot. If you want more information, perhaps you can go to a different section, but we're trying to keep the reader as much as possible on this page. We don't want them putting it down for later. We don't want them going away from this page. We want to make sure they can get all the information they need on this page. Now, when we talk about cash you need, so working capital, that's where the cash flow statement comes in, right? So the previous statement, the income statement, was showing how well your business was working. So if you think about it like a car, the income statement or the profit and loss statement, they're both the same thing. That's kind of telling you this is the miles per gallon I'm getting for my car, right? So I can understand how efficient my car is at using gas. Gas is cash. In the cash flow statement, this is telling you, well, how much gas is in my gas tank, right? Because if my gas tank goes empty, I don't care how efficient my business was, I'm not going anywhere. I don't care how many miles per gallon my car got. If there's no gas in my car, if there's no cash in my bank account, I'm not going anywhere because I can't pay my bills. So that's why, again, we're going to look at the bottom. In this case, we have working capital put into the loan so we don't go negative on the bottom, right? And we have some padding just in case there's an unexpected cost in there. We have some padding built in there. But what we did is we asked for the working capital to make sure this wasn't negative. Before, when we're working with the SBDC to try to create this model, we'll see a negative, right? Because in the beginning, we're actually losing money until we get up and running, get the clients that we want for the products and services, right? Because it takes a while to build a business. So here we worked with the SBDC to try to figure out, okay, how much working capital do we need to make sure that isn't negative? Because the worst thing you can do as a business is run out of cash and you go back to your lender a month or two later saying, I can't make payroll, I really need a loan. Well, how much confidence does that lender or that investor have in your ability to run that business now? And they might say no, and you're sunk. So you want to make sure you're projecting and asking for the cash right up front so that you're not going to go negative. And that's why understanding the numbers is so important. Because if you overinflate your numbers and try to make it look like you're going to do better, you're just hurting yourself because now you're not going to know that you need more cash, right? Most businesses fail not because they're not profitable, they fail because they run out of cash. And that leads to all sorts of problems of, okay, I need to cut people's hours or people quit or I need to discount my product to get more cash in the door. It's just a vicious cycle that leads down. Now, the other statement that a typical bank would want is a balance sheet. Now, the previous statements we're looking at the first year broken down by month. This statement, the balance sheet, is a set period of time. It's a snapshot. It's on this day, and this day happens to be on the closing day of the loan. So when I got this loan, this is what my assets look like, and this is what my liabilities look like. Now, for a startup business, it's an important piece, but it isn't going to tell the bank very much because your debt is going to be so high typically compared to your assets, right? If you're an existing business, this becomes much more relevant because now your assets and your liabilities should even out a little bit. But again, the Small Business Development Center can help you put this together. And the last thing we're looking at is that break-even analysis and or ratios, right? The break-even analysis is good just to understand, okay, what is the minimum amount of sales I need for my products or services just to pay the bills, right? So yes, I'm projecting up here, I'm hoping I'm gonna get this, but let's bring it down to the real level of I need to do at least this to make sure I pay my bills. Because that way, you know, the lender or the investor can understand, oh, okay, I know how much you need to do now. Okay, now I'm gonna try to ascertain if that number is believable and if your projections are believable. And more than likely, my number in my head is gonna come up between those two. But as long as it's above that break even, it might be below your projections, but if it's above that break even for what they feel, you're more likely to find them receptive to giving you that loan, right? And then, of course, you got ratios down below. Any lender or investor is going to try to figure out what are your projections saying that you're going to do, and then what is your industry average, right? So if I am in a retail market, in my typical gross profit is razor thin, it's 1 to 3%. If I write a business plan and my financials are saying that I'm going to make 8% profit, well, why is it that I'm going to make so much more profit compared to my industry, or vice versa? If I'm saying I'm only going to make 3% and my industry average is 8% profit, well, why is it that I'm not as profitable as the average of my industry, right? This is the industry average really lets you understand, you know, do I need to explain my numbers a little more, or are my numbers off a little bit, right? This is your check of why are my numbers different than the average? And they could be different and there could be a perfectly valid reason for it, but this is your chance to explain that reason. Why would it be different than the average? So again, the financial section is much more complex than I could possibly do in a video, and I strongly urge you to see one of our certified business advisors. We have locations throughout the state to try to help you do these financials. I am going to try to come out with different videos that break down the financials one by one, but for this video, that's all I got. Okay.